Welcome back to All Things Money. My name is David Blain, and during today's show, we're giving you our 2011 outlook, what we foresee for 2011 for the stock market, bond market, the economy, inflation, all sorts of different things. We'll get into a little bit about what this means. One of the things that I always try to say when trying to predict the market for the year ahead, well, first of all, nobody can predict the markets. If they could, they would very rapidly accumulate all the wealth in the world. So we don't think they can necessarily be predicted. There's no way of knowing. Actually, what ends up driving markets and economies and inflation is unanticipated events. And so we're going to have unanticipated developments next year that are going to ultimately drive the markets and the economy, and we don't know what they are. So rather than taking our predictions, we want you to take them seriously because they're based on historical fact, but we don't have a crystal ball, and so what we prefer to do is lay out sort of this roadmap of where we think things will go, and that gives us an idea of what to look for that would be different from that and would cause us to change our direction. Before we get into continuing with the outlook, let me give you our phone number, 252-633-0107. If you have any comments or questions, we'd love to hear from you. The email is allthingsmoney@dlblain.com. And you can always reach us through our website, which is www.dlblain.com. So let's continue on. We went through the stock market and the economy, just a general overview in the first segment. Moving on to fixed income. For Treasury yields, we see a modest yield uptrend in the bond market, Treasury specifically. We would look for yields on the 10-year notes to stay in the 3 to 4% range in the first half of the year, creeping up to 3.5 to 4.5% in the latter half of the year. As far as security selection in the fixed income market, we're still emphasizing what we call the spread product, meaning bonds that have some credit risk over treasuries, such as corporate bonds, high yield bonds, things of that nature. And we would expect that theme to continue on throughout 2011. We're not anticipating having to go too conservative in the bond portfolio. In terms of currencies and commodities, the dollar has been rather surprising here in the last couple of months of the year, its strength. We think that part of that will continue in the first half of the year, along with the commodity currencies such as the Australian dollar, the Canadian dollar, some of those currencies of countries that deal a lot in commodities. The second half of the year, we don't really see any major moves up or down for the dollar or other currency. We would anticipate most currencies be in a trading range. Gold, everybody's favorite topic. Gold is a little bit stalled here the past 6 months of the year. We think its long-term upward trend is still intact. It would not surprise us if gold continued to move higher, especially in the second half of the year. As the markets start to sell off, people will probably move back towards gold. So although we don't expect the returns of gold that maybe you saw in 2010 or the past few years, we don't think that gold is headed for a huge downfall anytime soon. But once again, like I said, we want to keep an eye on our indicators and not put too much weight in what we're sitting here in 2010, looking forward to 2011. So commodities, kind of the same thing. We look at commodities overall as continuing a strong theme, possibly some weakness later in next year. So that's kind of the broad overview of what we think is going to happen. As we move into the specifics, let's circle back, start with the stock market. As we said in the first segment, we think that stocks will continue to move higher in tandem with interest rates. As interest rates move up, there is some risk to the bull market. Typically, stocks do like a little bit of inflation. A little bit of inflationary environment is good for companies. It's the either A, unanticipated inflation, or B, too much inflation that the market doesn't like. A couple of things we would expect a peak to occur next year. Right now, as we look at some of the sentiment, we look at like the Consumer Conference Board, latest numbers still show that the consumer is fairly pessimistic on the economy as a whole. When that happens, it's actually good for the market. If you remember from previous shows, I emphasize this all the time, is over-optimism. When everybody thinks the economy and the market is doing great, that's when you need to be fearful of the market going down. When everybody's pessimistic and they think that the stock market is never going to come back and there's never going to be prosperity, that's when you want to be greedy and investing. And so we see that the consumer confidence is still low. In the range that consumer confidence is in now, the market has gained on average since 1960s, when this poll first started coming out, has gained an average of 14.2%. In contrast, when consumer confidence is very high, what we call the extreme optimism phase, the markets have gained on average 0.2% per annum. You may have heard the saying that stock market goes up a wall of worry, and so that's what is actually good for the market. As long as there's some pessimism out there still, we think that the market can continue to go higher. We're going to take a short break here, and when we come back, we'll finish up with some more details on the market, what we see, as well as the economy and for bonds. So for All Things Money, I'm David Blain, and we'll be right back with our 2011 outlook after a few short messages.